Hi, this is Kelly from Regis Financial Partners. Thank you for joining us. This is our take two of the cost of silence. Ignoring the disability conversation isn't an option anymore. With us today is Vinny from Mass Mutual, and I'm going to let him take it away.
Thank you, Kelly. Greatly appreciate it. I'd also like to say thank you to Regis Financial for the opportunity to present today. Again, my name is Vincent Seaha. I'm a Disability Regional Director over at Mass Mutual. What we're going to talk about today is, as Kelly mentioned, the cost of silence, why you shouldn't wait to have the disability conversation. There's three main things that we're going to talk about in the next 25 or so minutes. The first one is tailor-made specifically for this conversation. I think you're really going to like it. It's very different in the disability space, but no other carrier really has anything like it. More of an illustration topper than anything else. The second thing is going to be a couple of ideas around very specific target markets, where Mass Mutual makes sense, where you could target folks in the disability space. And then the third thing that we're going to talk about at the end is language. So we want to leave you with something, again, that is actionable, that is usable. You could go to a client tomorrow and have a conversation with them. So let's start with that illustration topper. I think if you've never seen this before, I think you'll really like it. Again, it's very different in the disability space. So really what this comes down to is, if you are, from an advisor perspective, if you're not sure how to bring up disability coverage, this is a phenomenal way to do that. So it is systematic, it is regimented. You can get comfortable having this conversation over and over and over. And what it's going to do is show the value of why it makes sense to own disability coverage. Money managers and financial planners also tend to relate with this output that I'm going to show you, this illustration topper, because they're getting key pieces of information that you would need in order to create this output, which that'll make sense in a second. But from a client profile perspective, as you think about your book of business and you think about prospects that you're having conversations with, individuals that are focused on retirement and the accumulation of assets, they're going to relate to this output. They're going to like this. Someone who believes they're never going to become too sick or hurt to work, this is a phenomenal piece for them. I would say folks between late 20s and maybe 55, somewhere in that range is where this makes sense. As you think about your clients and prospects, and $100,000 of income plus really is the target market for something like this. So the example that we're going to give is for a 30-year-old medical professional making $130,000 a year. So the one thing that's a little bit different that you typically don't need in a disability conversation, you can just ignore the screen. I'm just going to talk through this. But the one thing that is different is you need to know the level of assets that someone has. Do they have zero? If they have zero, that's okay. Do they have 50,000 in a brokerage account? Do they have 2 million, 5 million, 10 million in a brokerage account, or 401k or IRA or 403b, whatever the case may be? If that's a number that you're going to need to know in order to create an output like this. So let me show you what I've been prepping you for here. This is the illustration output. So again, picture you're having a conversation with this 30-year-old male medical professional making $131,000 a year. You can create this output, reach out to your partners at Regis Financial. They can send something over to you that is tailor-made for your client. So all of these outputs can be modified based on your client's circumstances. Again, if they're 40 years old, 50 years old, they have $1 million, $2 million, $5 million, all of these outputs can be modified. So when you're looking at the screen here, everything on the left, there's two scenarios. Everything on the left is assuming the client does not own any disability coverage at all. Everything on the right is assuming they do make the decision to purchase disability coverage. And excuse me, I should have said everything in blue. Everything in blue on the left is assuming they do not own disability coverage. Everything green on the right is assuming they do make the decision to purchase DI. So in this example, this 30-year-old medical professional, he had $250,000 of assets. We chose 6% rate of return. Again, you can change that based on your specific needs. At retirement, I'm going to use round numbers. It's 1.921 if you can't see the screen there. Let's just say they have $2 million. They're starting with 250, growing at a 6% rate of return. By the time they're ready to retire, they have about $2 million of assets. Now, here's where the magic happens. What happens if this person is too sick or hurt to work? How does that impact their ability to maintain their standard of living in retirement, right? So the 250 growing at 6% rate of return is 2 million bucks. That same 250 growing at the same 6% rate of return, if this person is hurt or sick in this example for 5 years, you can see 5 line items here, that 250, or excuse me, that 2 million goes to about $250,000 of assets. That 2 million goes to about $250,000 of assets. The assumption here is if you're too sick or hurt to work, you don't have an income. You don't have an income, you need to pull from somewhere in order to maintain your standard of living. You need to pull from somewhere in order to keep a roof over your head, to put food on the table, to pay your car payment, et cetera, et cetera. So again, that 2 million goes to 234, let's just say $250,000. Massive, massive delta there. Now here's where you can kind of bring the conversation home. Whoever you're having a conversation with, Mr. and Mrs. Klein, I know you love to golf. I know you love to shop. I know you love to travel. How would that impact your ability to maintain your standard of living in retirement? All right. So in order to be fair, again, everything in blue is assuming they do not own DI coverage. If you don't own DI coverage, you don't have a DI premium. So what they did is they took the DI premium as a side account or side fund, grew it at that same 6% rate of return. That equals, again, about $250,000, somewhere in that range, $255,000 to be exact. So if you add together your brokerage account that you pulled from after you were too sick or hurt to work, the 250 there, plus your side account, you didn't own a disability policy, that gives you about $500,000 of assets at retirement. Now, let's compare that same client in green. They do own a disability policy. What does this look like? Their same 250 grows at the same 6% rate of return. They're disabled for the same 5-year period of time. So they have $2 million in their brokerage account. The difference here is they have an individual disability policy to help them maintain their standard of living. They do not need to pull from that brokerage account in this case in order to maintain their standard of living. So they still have the full $2 million of assets at retirement. The opportunity cost here is they do have a disability premium. So what they do is they subtract out the disability premium from the about $2 million of assets, and that gives you about 1.66 million, let's say 1.7 million. So again, what we're really trying to do is put this directly in front of a client. Here's why it makes sense to own disability insurance. Here's why we need to have this conversation and why this is so important. How would you maintain your standard of living if you didn't have it and something were to happen, right? So the difference here being about $1.2 million in assets. $1.2 million in assets. The thought process here is we really want to kind of hit the client in the chest a little bit with this. Like this could happen and this could impact your retirement. It has a little bit of a shock and awe factor, right? So think back to originally the folks where this conversation makes the most sense. Folks who care about retirement savings and assets, right? Those folks are going to care when you show them an example like this, how drastic that delta is. Pretend the person had $1 million or $2 million or $3 million in assets. That number, that $1.2 million here is going to be even larger, right? That difference is going to be even larger because their standard of living probably is going to be larger. So again, phenomenal output. You could reach out to your partners at Regis Financial. They can get this run for you for your exact client's circumstances, for their age, for their net worth, for their level of assets, for their occupation. And this is something for you as an advisor where you can get comfortable with this output, having this conversation over and over and over. And again, what it's doing is it's showing the value of owning disability insurance in relation to something that clients really tend to care about, that is retirement, right? That travel, that golf, whatever folks like to do. So a very interesting output here. Again, reach out to Regis if you want to see something for your client. Now, the cost of silence or the cost of ownership, this is another interesting sales idea or sales concept. So when you think about disability coverage, traditionally, disability is discussed as a monthly or annual premium, typically, right? So let's say it's $5,000 a year for a monthly benefit amount, $6,000 a monthly benefit. right? $5,000 premium for a $6,000 monthly benefit. This screenshot right here is actually from our illustration system, our illustration output. Our illustration system automatically does this. I really like the concept of stretching the mind. Stretching the mind. So this is a 35-year-old male making $250,000 of income per year. Why not talk about the total potential disability payout under the policy? So in this case, you can see at the top, it's $11,800 monthly benefit. What they did was they took that $11,800, they multiplied it all the way out to age 65. That's $4,071,000 in the middle towards the bottom of the screen here, and potential disability payments. So rather than discussing disability as a monthly benefit amount, we're discussing disability as the total aggregate potential payout that policy has. You're stretching the mind of the client, right? You're paying your $238 a month for over $4 million in tax-free benefits. That sounds very different than paying your $238 a month for your $11,800 a month benefit. So very interesting from a sales concept perspective, changing the way that disability insurance is positioned. And again, looking at the total aggregate payout of the policy really shows the cost of not focusing on disability coverage. So again, automatically included in the illustration output, just a really good sales idea, I think, in the disability space. Now, the second thing that we were going to discuss today was some unique MassMutual offerings. Some unique MassMutual offerings. So this is very, very niche, a very niche market. For the producers on the line who have very high income earning clients, this program is for you. This program is for you. So let me tell you the negatives first. We cannot do medical and we cannot do dental. So this would have to be a hedge fund manager, an attorney, a business owner. So for this program specifically, exclude medical dental. If the person's in California, Florida, or Puerto Rico, we cannot utilize this program. So what this is for is individuals earning, it says 800,000 on the screen, let's just say $1 million plus. Very, very high income earning individuals. This functions very similar to a Lloyd's of London policy. So in the disability space, the traditional carriers, the MassMutuals, the Principals, the Standards, the Emeritoses, they have a specific total benefit amount that they're willing to offer one person, right? A maximum that they're willing to offer one person. That could be 30,000, 35,000, somewhere in that range. What this does is it layers over and above that existing coverage. That's hence the need for the very, very high income. So again, this functions very similar to a Lloyd's policy that would pay out over and above your traditional disability coverage. So a couple of key benefits here are a Lloyd's of London policy, you have to go back, traditionally you have to go back through underwriting every 3 or 5 years. With this, completely locked in. All the way out to age 65, never have to go back through underwriting again. The other thing that's interesting is Lloyd's policies tend to not have mental nervous language. This has mental nervous language. The other thing that's interesting is this is participating, which is actually the next slide. This policy pays a dividend. Lloyd's policies do not pay a dividend. And I'll explain more about the dividend in a second. So from the client's perspective, this is a phenomenal policy. It's guaranteed, it's locked in, it pays a dividend, it has mental nervous language. It's very competitively priced. From your perspective as the producer, it pays full compensation. Pays full compensation. The Lloyd's, if you've never sold one before, has a much more limited compensation structure. So really, it's better all around. It's better for the client and it's better for you as the producer. It's just a phenomenal niche market and sales concept that a lot of folks don't even know exists. A lot of folks don't even know that this is an option out there. So if you're thinking about your book of business, as you're thinking about prospects, non-medical dental folks making $1 million a year plus, if they're maxed out with a traditional carrier, this is a phenomenal option for you. Sorry, the dividends, I think, is the next slide, actually. This pairs perfectly, actually, with the executive select conversation. You don't need to worry about the numbers on the screen. I'll explain it to you. MassMutual just made a couple of really big changes. So for medical professionals, this is, again, separate and distinct from the executive select that we just discussed. This is Total benefit amount that we're willing to offer on one life. Old world, it was $20,000 a month if you were a medical professional. So it didn't matter if you made $10 million a year, MassMutual never offered more than $20,000 a month for you as a medical professional. We just increased that from $20,000 to $30,000. So about a 1/3 increase in how much coverage we're willing to offer, one life, one person. The other thing that's really interesting is we increased the total amount for 4A, 5A Act classes, which really just white collar executives, folks who are making very high income. So this is the piece that really pairs very well with the executive select. So you have an attorney, you have an actuary, you have a business owner, someone who's making a lot of dollars. We went from 30 to 35. And if they have group coverage in force, we can actually participate to 40. Participate just means all coverage, including all coverage. We can go to 40,000 a month, which is higher than virtually all carriers out there. So MassMutual really is going after higher earning individuals, higher earning folks, just from a sales perspective. You have a conversation with a prospect or client, they're making a very large income, they're probably a good MassMutual disability client. And the last one that I hinted at a couple times here is dividends. There's 3 major carriers in the industry, one in the brokerage space that offers dividends, and MassMutual is one of them. So MassMutual is a mutual carrier, which means the policy owners own MassMutual. Just like a stock company, the stockholders own the stock company. It's not the same thing, but it functions in a somewhat similar manner where if I own AT&T stock, I'm part owner of AT&T and I'm eligible for a non-guaranteed dividend. The big difference is when you are a MassMutual disability policy owner, you are part owner of MassMutual, you are eligible for a dividend, but that dividend is considered a return of premium and tax-free. Tax-free. So traditionally, this dividend is not guaranteed, just like it's not guaranteed from a stock company, but MassMutual has never not paid a dividend on their individual fully underwritten blocks of business. We have a very strong history of paying dividends. How that functions in practice is in most states, every year after the 5th policy year moving forward, you get 10% of your premium returned to you tax-free. 10% of your premium returned to you tax-free. So let's say you have a $10,000 annual premium, you're going to get about a $1,000 check in the mail tax-free every year after the 5th policy year moving forward. So the really cool conversation, clients typically don't remember that it's a participating policy. They'll call you and say, hey, why am I getting this check in the mail for $900 from MassMutual? What is this about? And you have a great story. Hey, you're part owner of MassMutual. They manage their expenses and their profitability great, and they return part of that back to you in the form of a dividend. It's tax-free. Go out to a nice dinner with your whole family. Now, you could go to a really nice dinner with $900 with your whole family, I think. So, again, just a very niche thing that's very different that MassMutual has. Now, the last thing we wanted to leave you with here is having the conversation. We wanted this to be something, again, that is actionable, something that you could use tomorrow. If you're not comfortable having the conversation, then you're probably not going to bring up disability coverage, so we wanted to end here. And again, that Simplify tool, the very first output that I showed you, is another phenomenal resource for that as well. But what we're showing here are the 5 most common questions that a client would ask you as the advisor if you were to bring up disability coverage. So my thought process here is I want to give you very simple, easy responses that typically will not elicit additional questions. You want to fully encapsulate the answer so that you don't get additional questions. So you could probably picture a client asking you, how do I qualify for benefits? How do I qualify for benefits? A very simple, easy response that, again, shouldn't elicit a lot of additional questions is, can you do your job? Yes or no? Can you do your job? Yes or no? As with a lot of these answers, it is, of course, much more complex than that, but I'm oversimplifying this to help with your conversations with clients. So the policy pays out based on an inability to do your job. Can you do your job? Yes or no? That's a very simple response that typically won't elicit a lot of additional questions, right? If I'm a surgeon and I have a shake or a tick in my hand, I can't do surgery. I can't do my job. That's a potential disability payout. How much in benefit will I receive? So disability policies attempt to replace about 60% of your client's income, of your income, Mr. or Mrs. Client. We're assuming you're having the conversation with the client. They attempt to replace about 60% of your income. Again, very simple, easy response, shouldn't elicit a lot of additional questions. How that works in real life, just to give you a little bit more of a technical answer, is the lower your income is on the income spectrum, the higher the percentage of that income the insurance company covers. So if I make $20,000 a year, they may cover 85, 90% of my income. Other end of the spectrum, I make $2 million a year, $3 million a year, $5 million a year. The insurance company may cover 20% of my income, 15% of my income. So it's a sliding scale technically. When will I begin to receive benefits? The vast majority of disability policies sold out there have a 90-day wait. They have a 90-day wait. Very simple, easy response. That's probably what you're going to end up offering. The increase in premium, from my perspective, to go to a 60-day wait is just not worth it. So you really want to have 3 months of cash on the sidelines from the client's perspective. How long will benefits last? It's very a la carte. An easy response would be typically until retirement, but the options are age 65, age 67, age 70. There's even a couple of shorter ones like 2-year, 5-year, 10-year benefit period, but our easy response for a client would be to retirement, to age 65. That's typically what's chosen in the disability space. And what if I return to work part-time? I'm eligible typically for part of my disability benefit. If I return to work part-time, I'm typically eligible for part of my disability benefit. If I can't do my job at all, I'm typically eligible for all of my disability benefit. So can't do my job at all, potentially 100% of your benefit. Can do part of your job, you'll probably get part of your disability benefit. Very simple, easy response that a client would understand. And again, won't elicit a lot of additional questions. So hopefully that is helpful. I have one more slide here around language. This is very, very common in the disability space, so I want to make sure that I brought it up. This is a phenomenal way that Regis and MassMutual can help you in your disability conversations. Group long-term disability coverage. If you're having clients that work for medium or larger size companies, typically they're going to have disability coverage in force for their employees. So it's a very common response that you get from a client. I already have it through my employer, I'm all set. So I want to give you a couple of items around language that you can use in that conversation with your client. So number one, I would probably compliment the person, hey, that's great that you work for a company that's fiscally and financially strong enough to be able to offer group long-term disability coverage. Not everybody has that. When was the last time you reviewed it, and do you know how it works? Great language here. When was the last time you reviewed it, and do you know how it works? I promise you they're going to have no idea how it works, and the last time they reviewed it was probably when they first started at their company, right? So a couple of interesting bullets that you can throw out there to try to get them to get their hands on their group policy. So again, if you can get your hands on the group long-term disability policy, send it to Regis Financial. We'll be able to help dissect it, give you 3, 4, 5 bullets on how the plan works, and then why it makes sense to supplement over and above the additional coverage. This is one of the best ways that MassMutual and Regis together can help you in the disability conversation. So just to give you a couple of bullets here as to why it makes sense for the client to go gather that group plan is group plans cover a percentage of your income, not all of your income, right? 50, 60, 66%, somewhere in that range is pretty much industry standard. The other thing that's interesting is that's typically, not always, but typically taxable. So the client thinks that they're going to get maybe 100% of their income or even 60% of their income, but they're not factoring in that it's typically taxable to them. The other thing that's interesting is the group plan typically doesn't cover bonus or incentive compensation. So if you're having a conversation with an executive or a salesperson who has a somewhat smaller base salary with a very large bonus component to their income, usually they're going to get 50, 60% of their base salary. They're going to ignore the bonus compensation, and it's going to be taxable. So there's a huge hole there that they don't realize where they can add additional coverage. So we started with what, I don't think I mentioned this, it's called the Simplify tool, that output at the beginning, that systematic, regimented, process-oriented output to help bring up the disability conversation and show the value, why it makes sense to own disability coverage. Then we went into a couple of sales concepts. Remember, stretching the mind, right? Rather than talking about disability insurance as a monthly benefit amount, look at the total aggregate potential payout. You can stretch the client's mind to show them the value of owning that coverage. Then we talked about a couple of key markets. We talked about folks making $800 or $1 million plus, that Lloyd's of London replacement policy. We talked about the limits increasing over at Mass Mutual, our dividends, and then a lot around language. So I just want to end by saying thank you again to Kelly. Thank you to Regis. I always appreciate the opportunity to present and have conversations with your producers. I hope everybody has a great day. Thank you.
Thank you, Vinny. This was wonderful. I really appreciate you taking the time with us today.
No problem.